Hello everyone, this is Samie and you're watching the series of eAcademe from the platform of CA Educationist. In this video, I will be talking about the financial statements. Financial statements are a set of statements that tell the readers about how well a business financially performed during the entire period and what is the situation of its financial health at the end of that period. Consider the example of annual report of a student which is shared by the school management with his parents at the end of a year. The report enables the parents to know how well he scored in class tests, how much percentage marks he secured in examination, how participative he was during class sessions, how is he rated in terms of classroom behavior, how much interest he showed in extracurricular activities, and where is he standing right now. Just like parents want to know about the progress of their child and his current status after each period, every businessman wants to know about the progress of his business and its state of affairs at the end of each period. Just like parents are investing money, time, and efforts on their child with an expectation that he will produce positive results, every businessman also invests capital, time, and energies in his business with an expectation of getting positive financial results. These financial results are determined and reported through financial statements. A complete set of financial statements include 5 components or 5 statements that are intricately linked with one another. Let's discuss each one of them one by one. Income statement. The statement that helps the owner to know the financial performance of his business during the period is termed as the income statement or statement of comprehensive income. This statement reflects the activities of a business during a certain period. It shows the monetary value of all units sold or services rendered by the business during the period, which is termed as sale revenue. Moreover, it discloses the monetary value of production and operating expenses incurred by the business in selling those units or rendering those services, including manufacturing costs, selling and distribution expenses, administrative expenses, finance costs, also known as interest on business loan, and other miscellaneous revenue expenditures. It then compares the revenues with expenses and computes whether the business earned profit or incurred losses from its operations during the period. Profit is an indicator of favorable performance and reflects that the business has earned money over and above its operational expenses and generated surplus. On the other hand, loss is an indicator of adverse performance and reflects that the business has not even been able to recover its operational expenses and resulted in a financial deficit. This statement is normally prepared on accrual basis. I have already explained accrual basis of accounting in one of my videos whose link is available in this video's description. Balance sheet. Balance sheet is also known as the statement of financial position. Before explaining this statement, let me mention that the entire amount of money invested in a business, whether obtained from owners or lenders, is used to purchase long-term and short-term assets for the business so that it can operate to achieve its intended objective. For example, the finance may be used to purchase the assets like land, building, machinery, vehicles, computer equipment, etc. to support business operations. Likewise, stock in trade or raw material inventory items have to be purchased for trading or manufacturing of products for sale. The unused cash held by the business is also reflected as cash at bank or cash in hand. So, balance sheet shows the current status or snapshot of these business assets and the financing side of the business. It is also called the statement of sources and resources. The financing side represents the sources from where the finance is obtained, whereas the asset side represents the resources purchased from the available finance. Long-term assets of the business, except land, are subjected to depreciation. Moreover, new acquisitions, disposals, or revaluations cause changes in these long-term assets from time to time. Likewise, inventory items are constantly purchased and traded or used in manufacturing of products, thereby causing changes in inventory levels as well. Level of cash at bank and cash in hand is also subjected to constant variation based on utilization and cash collection from customers. Likewise, the financing side undergoes changes from time to time, including repayment of loan, borrowing of new loan, raising new finance from owners, drawings by the owners, and increase or decrease in owners' wealth caused by profits or losses respectively. So, balance sheet is usually prepared at the end of each period to evaluate how much monetary changes have occurred in each line item of assets and finance side at the period end. In other words, updated balance of each line item is reported in balance sheet at the end of each period. The aggregate value of asset side and financing side must always be equal. Difference in these values indicates an error that must be identified and adjusted. The line items on both sides of balance sheet are placed in the order of liquidity. The most illiquid item is placed at the top and the most liquid item is placed at the last line item. Both sides of the balance sheet are further bifurcated into long-term and short-term portions. Long-term assets, also known as fixed assets, have the ability to generate economic benefits for more than 1 year, whereas current assets have the ability to generate economic benefits only within a year. Likewise, long-term finances are obtained for more than a year, whereas current liabilities are those sources of finance that are obtained for less than a year. There are some other items in the balance sheet as well. Since the purpose of this video is to develop the basic understanding of each statement, I am ignoring the discussion of those items. In a nutshell, balance sheet provides an overview of assets, liabilities, and owner's equity of a business at a particular point in time. Cash flow statement. Cash flow statement is also known as the statement of cash flows. The balances of cash at bank and cash in hand as reported in balance sheet are computed from this statement. This statement simply takes the closing cash balance from the previous period, also known as the opening balance, incorporates the changes in cash during the current period and computes updated closing balance of cash to be reported in balance sheet. All cash inflows and outflows of a business arising during the period due to operating, financing, or investing activities are adjusted to the previous period's balance to compute updated cash balance at the end of the current period, which is reported in balance sheet subsequently. In a nutshell, this statement gives a complete overview of all the activities that generated cash and all the activities in which cash was utilized by the business during a certain period. Statement of changes in equity. This statement is also known as the statement of owner's equity. The balance of owner's equity as reported in the balance sheet is computed from this statement. As the name indicates, this statement simply takes the closing balance of owner's equity from the previous period, incorporates the changes in equity during the current period, and computes the updated closing balance of equity to be reported in the financing side of balance sheet. Changes in owner's equity during the period is mainly caused by profit or loss, distribution of dividend if any, drawings by the owners, or introduction of new equity finance. Just like balance sheet, there are some other items in this statement as well. Just to keep the thing simple, I am ignoring the discussion of those items. Notes to the accounts. There are the additional information and explanations that accompany the financial statements. They provide more details and clarity about the reported items. For ease, this component can simply be considered as an annexure to the financial statements containing breakups of different items as presented on the face of financial statements. The financial statements are prepared by the management of a business entity, who are usually different from the owners. These financial statements are used by different stakeholders of the business for different purposes. These financial statements are used by different stakeholders of the business for different purposes. In addition to providing key financial information, these statements elevate the confidence and trust of the stakeholders in a business. For example, as mentioned earlier, owners are interested in these statements as they want to understand the performance of their investment. This helps them in making future investment decisions. Lenders. Since they have lent money to the business, they are interested in these statements to estimate the ability of the business to repay the loan amount and associated interest charges. Suppliers will require financial statements in order to decide whether it is safe to extend credit to the company or not. Customers. When a customer is considering which supplier to select for a major contract, it wants to review their financial statements first, in order to judge the financial ability of a supplier to remain in business long enough to provide the goods or services mandated in the contract. Likewise, the management team needs to understand the profitability, liquidity, and cash flows of the business every month so that it can make operational and financing decisions about the business. Employees analyze the financial statements from a different angle. Since their remuneration, bonuses, and increments are directly dependent on the financial performance of their employer, employees are interested in evaluating the employer's financial capability to afford bonuses, increments, etc. Competitors of a business will also be highly interested in its financial statements to evaluate its financial condition. The information they receive from these statements may alter their competitive business strategies. A government will also be interested in reviewing the financial statements of the business in order to determine whether the appropriate tax amount was paid or not. Thank you for watching the video. For more videos, keep watching the series of eAcademe from the platform of CA Educationist by Mohammed Samie. For any queries, you may WhatsApp or email at the given contact details.